Hi, I'm Bill Blaine, market strategist with ShardCapital here in London. Let's talk about markets this week. It's been absolutely fascinating. We saw the markets collapse last week after Donald Trump announced new measures against China. We then saw China retaliate. Markets continued to dump, and then we've seen something of a stabilization. Stocks have basically taken a small correction. And certainly they didn't react well last week to the Federal Reserve's 25 basis point cut in rates on the basis that there was no discernible plan for more rate cuts to follow. As a result, stock markets are very nervous. They're nervous about where US interest rates are going. They're nervous about the consequences for the global economy from a China-US trade spat. They are also nervous about where that is likely to go. It's no longer clear that China will be the ultimate loser. Many analysts now predict that it will be a zero-sum game for both, if not a possible win for China. All these things are influencing the stock market just now, but probably the most important factor keeping stock prices high is there's simply nothing else to do with money. We've now got nearly $14.5 trillion of global debt trading with negative yields. So why would you take money out of positively yielding stocks to put in negatively yielding bonds? That's one issue. But the place we should really be looking at just now for clues on where the global economy is going is the debt market. Because in debt markets, you have truth. Stock markets are always about expectations. They're about stories. It's looking for the right thing to buy on the expectation it's going to make trillions and billions. Bond markets are about the real economy and what's happening. And we're getting increasingly nervous that ultra-low interest rates have seriously damaged and disrupted corporate debt, and especially the junk bond markets, which are now massive in comparison to where they were before the last global crisis in 2007-2008. Spreads for junk bonds, which are those rated below investment grade, and those just on the cusp of junk at BBB, now look to be struggling. And that's a clear sign that investors anticipate a slower global economy, meaning these companies are going to struggle to repay their debts. We are seeing a reaction in the bond market because interest rates aren't expected to go down, but the ability of these companies to repay is not rising. We've also got the fear that the market will become increasingly illiquid, and that typically happens at a time when everyone is trying to exit corporate debt. So if you're looking for a real signal of how bad the global economy is getting, keep a very close eye on corporate debt spreads. My prediction is they're not going to get better, and they are a clear sign of coming recession.